What's up, Yichi here. In this video, we're going to talk about everything you need to know before buying a home here in Ontario. Let's jump right in. Before we even start looking at homes, it's important to know exactly what our budget is. Now, your house is going to be paid for by two things: your down payment in cash and your mortgage as a form of a loan from the bank. Now, theoretically speaking, if you had 100% cash, you could pay for your house and have no mortgage, but that probably wouldn't be a wise decision because you can probably earn a higher rate of return on your cash than the interest you're gonna have to pay on your mortgage. The minimum amount down you'll need for your house really depends on the purchase price of your house. Take a look at this graph that shows exactly how much you need for a down payment based on the purchase price of said property. Now, the sweet spot for the average person would be around 20% down. This way, you don't have to pay for mortgage insurance and you get a good amount of equity when you purchase your house. If your down payment is less than 20% of the purchase price of your house, you will need to buy mortgage insurance. Now, the mortgage insurance basically insures the lender in case you default on your mortgage payments. This premium or cost is essentially just added to your monthly mortgage payment. So for example, if you put less than 20% down and your interest on your mortgage is 5%, well, you'll probably end up paying something like 5.5 or 6%. So it's a premium on that mortgage. Okay, awesome. So the first step is to save up for that down payment. Now let's assume you've been able to save up that down payment for 20% of the purchase price of your house. The second step is to get a mortgage for the remaining 80% of the value of your house. Now, lenders typically lend 4 to 5 times your annual income. So let's say you make $100K, lenders will probably give you around $400,000 to $500,000. If there's two of you buying a house, double that. Now, if you're self-employed or have bad credit, lenders may not loan you as much money, or they may require a bigger down payment. It really depends on your unique situation. If you have any questions in regards to mortgages, reach out and I can hook you up with a mortgage specialist. Mortgage specialists can actually give you a better rate than when you go to the bank because they're able to shop around different lenders, whereas a mortgage specialist at a bank can only give you that bank's products. Once you speak with a mortgage specialist, they'll require additional documentation such as your ID, your T4 slips, credit score, employment letter, pay slips, things of that nature, just to verify your creditworthiness and your income. The next step is to decide whether we want a fixed or a variable interest rate on our mortgage. And to be honest, the right answer is highly dependent on the market. If you think rates will go up in the future or you want fixed payments, it's probably best to lock in a fixed rate. If you think rates will go down in the future, it may be wise to get a variable rate. It's important to note, however, that market conditions are already factored into the value of these rates, which is why we see a discrepancy over the last, call it 15 years on this chart. For example, if industry experts think the rates are going to go up in the future, then variable rates will be at a discount. Keep in mind that most mortgages in Canada are for 3 to 5 years, so you'll need to renew your mortgage in that amount of time. This is why you hear news stories always that a high risk of default is going to happen on mortgages because a lot of people locked in on low rates during the pandemic, but these rates will now be up for renewal in 2026, 2027 at a much higher rate.
Interest rates are at historic lows, Glenn.
Okay, great. We've now figured out whether we want a fixed or a variable interest rate. And to be honest, there is no right answer. It really depends on the market. It depends on your unique financial situation. The next step is to figure out what duration of the loan you want. In Canada, it's typically 25 or 30 years. I know in countries like Japan, they have like 60 or 70 years, which is kind of crazy to me, but it is what it is. But in Canada, let's say you pick a shorter term loan, well, your monthly payments are going to be higher, but the term of the loan is going to be shorter, so you're going to have it paid off faster. If you pick a longer loan, let's say 30 years, your monthlies are going to be lower, but you're going to be paying it for a longer period of time. And honestly, as I mentioned previously, there is no right answer. It really depends on your unique situation. Congratulations, you've now been able to save up for a down payment and you have a mortgage. On the day of closing, assuming you find a place and your offer was accepted, what the lawyers will do is take that down payment, so let's call it $100,000 from your bank, So you're gonna have a credit in your checkings account of $100,000, and the lender that you picked will be able to provide the remaining amount of cash. Both those sums will go to the seller, and now you've assumed the mortgage, which you'll have to pay. The first payment will be 30 days after closing. So you've assumed the mortgage, you've now paid the down payment, but you're now a homeowner. You've assumed title on the house. Congratulations. Now, there are other costs with purchasing a house here in Ontario as well. As a buyer, luckily, you don't have to pay realtor fees. It's the seller who ends up paying the realtor fees for both the buyer and the seller agent. You do have to pay for things such as lawyer fees. They handle all the movement of the money during closing. They handle the title change. They handle, co-ownership agreements if you want that. And the cost of a lawyer is typically around $1,000 to $1,500 for closing. It's a pretty standard process for them. They've done it tens of thousands of times. But yeah, $1,500 for lawyer fees. The other big fee that you have to pay for is the land transfer tax. Take a look at this. If you're buying a house in the municipality of Toronto, you actually have to pay land transfer tax twice. It's a tiered system calculated based on the purchase price of your house. If you're purchasing outside of Toronto, you just have to pay the land transfer tax once. This amount gets accumulated during the total or during closing and gets added to the total purchase price of your house. For $1 million home in Toronto, your land transfer tax is going to be around $24,000. Once you receive the keys and you've moved in, there are other costs that you may need to consider as well. For example, if you're buying a resale house, you might want to do renovations. For example, when we bought this house, there's no AC, and getting a new AC system in the house costs around $10K. The appliances are a bit old, and getting new appliances throughout the house, that's going to be around $5 to $7K. So you really have to budget and give yourself a buffer for these extra fees and costs. In addition, you're going to have to pay for things such as Wi-Fi, hydro, gas, and these bills will start occurring every month as well. And finally, those damn condo fees. If you bought a house, if it's a condo, you're going to have to pay monthly condo fees. So make sure you're aware of all the costs before you finalize your budget. Okay, enough of the finance talk. We know what our budget is, we know the costs, we know how to get a mortgage. It's time to go shopping. Now, just tell your realtor where exactly you want to buy your house. For example, North York, Stouffville, Markham, doesn't matter. Tell your realtor where, the budget that you have, and any other material facts that you deem important in finding a house. For example, it's got to be close to a highway. It's got to be close to a golf course. There's got to be no 5G towers close by, things of that nature, right? And once you've figured out your criteria, your realtor is going to send you a list of all the homes currently on the market that meet your criteria. And it's time to book some showings. If the house is vacant, you can probably go right away to see the house. But most of the time for these homes, they will be owner or tenant occupied, in which case you have to give 24 hours notice to see the house. Now, when you're looking at the house, attention to detail is everything. Don't be fooled. For example, if you walk into a kitchen and you see, oh, nice cabinets, beautiful hardware, well, you can get hardware that looks really nice for like $5 a pop at Home Depot. But maybe the appliances are old, and like I said earlier, to replace appliances is around $5,000 to $7,000. Or maybe there's no AC, so that might cost you 10 grand. Or maybe the shingles need to get replaced, or whatever. Attention to detail is super important when buying a house because this will affect the market and purchase price you need to pay. Awesome, we saw a house that we just loved. It's time to put it in offer. Now, there's two things that can happen. Either the seller is going to accept offers anytime, or the seller is holding offers until a specific date. Let's say 7 to 10 days from now, in which case they'll review all the offers on the house. Your realtor will tell you what the current strategy is, and you can prepare accordingly. When you place an offer, not only is the price important, but there are other things that are negotiable as well, such as the closing date, what chattels and fixtures are included, and even what clauses you want to put. For example, you're buying a house that's a little older. Well, you may want to put an inspection clause to make sure, the house is foundationally sound, or there's no mold or things that you can't see. Or maybe you want a financing clause to make sure that you are actually approved for the loan that you really want at the interest rate that you really want. You can add as many clauses like this as you want, but keep in mind the more clauses you add, the weaker your offer is going to be. So it really is a balancing act between protecting yourself, but also getting the house that you want. Congratulations, your offer was accepted by the seller. Now all we have to do is pay the deposit. Now the deposit is not the same as the down payment. The deposit is typically around 5%, and this amount will be paid via bank draft, wire transfer to the listing agent's brokerage's trust account, and this will be done 24 hours after acceptance. This amount will be deducted by the lawyers from your total purchase price that you owed at the time of closing. And that's really it. Now it's a waiting game until closing before we can move in. We have to fulfill any clauses that we put in, such as an inspection or financing clause. The lawyer will reach out and handle all of the movement of the money as well as the title change, and your realtor will be able to answer any other questions that you have. Congratulations, you are now officially a homeowner and hedged against inflation. Either move in yourself or rent it out for rental income. Either way, you have a greenhouse on the monopoly board. Even if the price decreases in the short term, house prices always go up in the long term, especially in Canada, because to be honest, they're just not building enough houses for the amount of immigration that we're getting. Either way, as your house price increases in value, you'll soon be able to take out a home equity line of credit, which is essentially just cash, to purchase other properties if you'd like. Buying a house is both an art and a science. It's both logical and emotional, and is definitely a roller coaster ride. If you need any help, please don't hesitate to reach out. And as always, thank you for watching, and we'll see you next time.